Welcome to Impact Farming, where we introduce you to the people and ideas that will have a massive impact on your farming operation. Brought to you by Farm Marketer. Sit down, start the engine, and let's roll with today's show.
Hello, everybody, and welcome back to another episode of the Impact Farming Show. Today, we have an amazing guest with us. We have Michael Langemeier from Purdue University. He is a professor there, and he is joining us today to talk about the 8 biggest financial mistakes that he sees farmers making. Welcome, Michael. How are you?
Pretty good. How are you?
Good. I am so happy to have you on the show. Michael and I were both on a panel together a few months back, and after that panel, I said, I got to have this guy on the show. So welcome.
Glad to be here.
Excellent. So what I'll get you to do is share a little bit more about yourself and your background with our audience, and then we'll dive right in.
Okay. Just a real short background on my academic background. I got a PhD in 1990 from Purdue University. Then I went to work for Kansas State University from 1990 to 2012. In 2012, I got an opportunity to come back to Purdue and work for the Center for Commercial Agriculture in primarily an outreach appointment. And so I give a lot of presentations and write quite a few extension papers for farm and agribusiness audiences. A little bit about my farm background. I was raised on a farm in east central Nebraska. My brother currently operates that farm and has been doing so since the early 1990s. My sister married a farmer. She's actually a high school teacher, but she married a farmer in northeast Nebraska, and so they operate a farm in northeast Nebraska. And I'm really pleased to say that my nephew has joined that farm now after graduating from college, and so he's back on the farm. My brother, he has 3 sons, and they're helping on the farm, and I think one of them is going to take over the farm maybe 5 to 10 years out. Okay. I think that both the farms that I'm associated with, or my family's associated with, are going to continue into the next generation.
That's awesome. And deep farming roots. So I understand where your passion comes from. And if you don't know, the audience knows all about me, but I love farming and the business of farming, and then the entrepreneurial and the business world. And that's kind of how this show got started. I just said, we really need to get brilliant minds in front of farmers with those business ideas that are tailored to farming, because you can take a mainstream business book or podcast, and yeah, it's relevant. But you know what? Farming's a little bit different. So that's how
there's definitely some unique aspects to farming. And one of the unique aspects is it tends to be a family-oriented business. That has some pluses, obviously, because you get to work with family members. But as you know, that can also have a downside occasionally if communication is problematic. But that's another feature that makes farming so unique. Feature that makes farming very unique is the fact, and there's other businesses like this, but farming is extremely capital intensive. You need land to farm, and land makes up a very large portion of most farms' balance sheet. In addition to that, you need quite a bit of machinery, buildings, grain bins, and all that together. You have a lot of money tied up in capital.
Don't I know? I have I'm a business owner times 2, and I look at the financials and the big picture of both of the operations. And my goodness, wow.
Yeah.
I hear ya. Okay, so that is fantastic. I am excited to dive right in. Why don't you take it away, and we'll just roll through the 8 points that you want to make, starting right at the top.
Yeah, I want to talk about the biggest financial mistakes kind of that I've seen, and also some concepts that are very important from finance that people need to think about. And one of the reasons why this is becoming more important is because of what we just talked about, the fact that the businesses are getting larger and more capital intensive. You just have to pay attention more to the financial position performance than you used to. Things get very complicated, very quick if you don't have a handle on these things. And one of the things that's talked a lot about in the business literature, it's also talked about in agriculture, of course, too, is you can't manage what you don't measure. Ooh. And so you're not measuring profitability, you're not measuring your financial position, which is the balance sheet. You really don't know where you're at, and it's very difficult to make decisions on, should I rent that additional 160 acres that's next to me? Should I buy land that's being sold right next to me? Can I afford to buy land that's right next to me? And really, to answer those decisions, you have to measure financial position and performance. And I'll get more specific and what I mean by that. And I like to pose a question. A lot of farmers really like the agronomic or the animal science aspects of the business. Would they even think about not measuring crop yields? All farmers know what every single cornfield made this year. 239, that was that field over there. This field made 205 because of X, Y, and Z. And same with animal performance. You know the feeding cost, the feed conversion of every pen of cattle or every pen of hogs. And so with that in mind, why wouldn't we also measure finance? I know it takes some professional development, perhaps, some reading up on some concepts that you may not be as familiar with as you are some of the production measures, but it's not that difficult to measure financial measures. And so one of the measures, for example, that I like people to look at is just a simple profit margin. Every business, including family-owned businesses, what their profit margin is. Is it 2%? Is it 5%? And how does that compare to other people in the industry? And if your profit margin is not as good as other people in the industry, then you have to think about, what am I doing wrong? Or what am I doing that's creating a situation where my profit margin is below the industry standard? And so just like other industries, agriculture has industry standards. And so that's just one example of a measure that farmers need to get a handle on. And one of the challenges with agriculture from a financial performance measure standpoint is, let's take a crop farm in Indiana, because I'm most familiar with those farms in the Corn Belt in the U.S. You only get one crop a year. There is some double cropping, in southern Indiana, for example, but you typically only get one crop a year, and so you don't have a lot of chances to make changes.
Right.
That makes it more complicated to react to a low profit margin, because you can't react immediately. You measure the profit margin for the end, using data for 2020, for example, and you have a crop that's going in the spring. To try to improve that profit margin, but you only get one chance. You only get one chance to make that a good crop for 2021, for example. And so that creates a challenge, but that doesn't mean that they shouldn't measure it.
I hear you, Michael. One of the things I always talk to my husband about, sorry to jump in there, but with farming, I think the good and the bad, there's a flip side to this. Each year we have a new shot. It's a new crop. Yes. And it's a new calf crop. So it's exciting. But like you said, if you farm for 25 years, 30 years, you only get that many shots. And in the beef world, if you make a decision, like how many times have we made a decision to use X bull? So you breed here, and then it takes that long to come. And then if you're keeping heifers or bulls, you're 2 to 3 years out on one decision. And if, heaven forbid, you pick the wrong bull, because you don't really know until the calf is on the ground, you're 3 to 4 years out until you're going, oops, or yay, right?
Yeah. And what we're talking about here is making production plans. Just make sure you follow up with any production plans or production changes or capital purchases. Let's say you buy a new planter. Follow up and decide whether that was a good decision. So help you make decisions down the road. And so that's the whole idea of just measuring financial position, which is more of the balance sheet approach, and financial performance, like measuring profit margin and rates of return. And I just want to reiterate something I did mention a little bit earlier here. this is particularly important if you're bringing another family member into the business.
Oh, yes.
Both my brother and sister, my sister's already brought someone into their farm, and my brother is thinking about bringing someone into his farm, because we need to answer two key questions. And this goes back to the transition planning that we talked about on the panel that we were involved in earlier this year. Is the farm large enough? You have to measure that. Is the farm large enough for another family member to join the business? And is it profitable enough?
Amen.
Profit margins. So there's going to be enough earnings there to support that extra family.
You know how many, I got to jump in there, Michael, because it is a pet peeve, hence why I started this show. But do you know how many farms I see right across Canada that bring in 2 families, 3 families, and I do some really quick math and go, that is an operation that at best, if you're squeezing it, is going to support 1 family.
Yes.
What's happening? And I don't know, and you'll know this better than I do. Again, I guess that's not measuring and not having financials, but sometimes I find, and it sounds so horrible, but there's a little bit of a dreamy, and it's not farming only. Even entrepreneurs start a business and they don't, it's about a dream, but we're not looking at the numbers, right?
Yes. And that goes back to something that's very important from a transition planning standpoint, is this whole idea of how does this new person fit? Any hire a person, particularly a family member, what skills is that person bringing? Maybe if the business is not profitable now, maybe this person has some specific skills that we can utilize to make the business more profitable. But if you're going to bring somebody back, at least answer that question. Realize that we need to do something different if we're going to survive with 3 families versus 2 families.
Yes. I love it. I love when you hit that point on the panel, just because I think it's, and again, we all want to farm and we want to make that family farm fit everyone, but is it practical, right?
Yeah, and just to reiterate, how easy it is to really measure, something like the profit margin. We would prefer that some people have an accrual income statement, but that sounds a little scary to some people. In the U.S., we have something called a Schedule F. That's our tax form for farmers. And so if you have a tax form for farmers and a beginning and ending balance sheet, you can use that information to calculate the financial ratios. And so it's not that difficult once you just figure out how to do it, and then just do it routinely at the beginning of every year.
I think numbers. Hey, I'm not a numbers person. The 4 personality types. I would not lean to being the accountant or the educator. That is taught, because I know how important it is, self-taught and university taught, because I know how important it is for business and making your business work. But you know what? The great thing I love about numbers versus managing people or any of crop production, numbers don't lie.
Yes.
Money comes in, money goes out. Just make sure it's in there, and then it's all right there. It's intimidating at first, but once you got that, man, do you feel good?
Yeah, and that leads me to a second point, is not realizing the importance of cash and working capital. And I'll define working capital here, shortly. But when the farm is growing and reinvesting, bringing a family member back, we not only need to know the profit margin or how profitable the farm is, we need to track the cash flows, because the cash flow is what we use to buy a combine. The cash flow is what we use to support another family member in the business. And so, but farmers usually have a better handle on the cash flows than they do the profitability. And so this isn't quite as complicated for a lot of people. Like we have a program down here called QuickBooks that people use a lot. It does a nice job of tracking cash flows for any business, and including farming, if you set it up right. Now let me get to the working capital, because this is think of this as a store or the storage place for cash. And what working capital is the short run current assets like cash, like grain in the bin, like market livestock. If you're a cow-calf producer, it wouldn't include the breeding livestock. They're not a current asset. They're a long-term asset, but it would include the calves, particularly if you retain ownership on those and you hold them after the first of the year. They would be a current asset. And so it's things that you could liquidate to pay current liabilities, like how much of your land loan is due in the next year. You want to have enough money to cover that. So something like that, but also operating debt. How am I going to pay my operating debt at the end of the year or after harvest? And so that's what working capital does. Is it sees if you have enough of these current short-term assets to cover these current liabilities. The current debt and the operating debt and the principal payments on long-term debt. And why is this important? Well, farms and businesses in general, the business literature talks a lot about this. They call it free cash flow. But that's the money you have to take advantage of opportunities. And so if I have have a solid working capital, I am much more able to rent that farm next to me. I am much more able to make the down payment on that land next to me that I want to buy. I am that much more able to buy the 50 bred heifers that I've been dreaming about buying from this guy that's liquidating. And so this working capital is really needed, to take advantage of opportunities. And in agriculture, because the agriculture is so capital intensive, what a lot of farms do, and this is a little worrisome sometimes, what a lot of farms do is they will keep the working capital relatively low because they'll use their profits to buy assets. When you're looking at using working capital, you always have to think, how much money do I need to repay debt? Do I have enough money to replace assets? Because the assets, machinery depreciates out. You have to replace it periodically. But you also have to have money in the bank, this working capital that's sitting there in case there's an opportunity. And this is complicated. But the key thing here is making sure you measure it and making sure that you have at least some working capital to pay the bills at the end of the year, but also just in case there is some opportunities that you'd really like to take advantage of.
Well, opportunity, but correct me if I'm wrong. Also the flip side of that, the not so fun, something comes up, something where you need money instantly. Maybe you're not planning on, you're an established farm and your status quo and Maybe you're not planning on doing any new purchases, but if something comes up and you don't have money, you're in trouble, right?
Yes. Yeah. A lot of businesses fail because there's not enough cash flow. They might be profitable. I mean, think about restaurants, for example. That's a classic case. They may be profitable when they look at how much they're charging compared to their expenses. Their profit margin's not bad, but they run out of cash. Why? Because it takes a lot of beginning cash to get that business rolling, and you run out of cash before you get enough business, before you have before you have a lot of people visiting the restaurant. Well, the same could happen with a new venture in agriculture. You put money into this new venture, a lot of the money has to be put up front. Yeah. And you got to make sure there's enough working capital there to make this new venture work, but also to make sure that the rest of the farm has enough money to pay the bills. And so tracking cash flow in addition to profit is absolutely essential.
I love it. I did another episode. It was titled really quick, Is Bigger Really Better? And we talk about whether we want to expand or not. But then we went into the hidden costs of new opportunities. Yes. I buy those 50 bred heifers, but it's going to be a while before I see that income, right?
Yes.
And like you said, how does that impact it? But anyways, that's a whole nother 5 episodes.
Yeah. And typically we have a rule of thumb that I typically use is you want enough working capital to at least pay your current liabilities for 2 years.
Okay. Wow.
Enough money to make sure you pay the bills for this year, but it gives you a little extra, for these opportunities. But also, let's say that 2021 is, heaven forbid, 2021 is not a very good crop year. You're a crop producer. We need some extra money there to pay the bills because the individuals we bought the inputs from, they don't necessarily care that it was a bad year. They still want to be paid. And so that's kind of our rule of thumb is having enough money, having enough working capital to at least pay for two years of current liabilities.
Yikes. For the average person, what do they say? The budgeting guys, what do they say? You should have, the person going to work should have 6 months saved.
Yeah.
Expenses, something like that. So you're saying the farm equivalent is 2 years of working capital.
Well, 1 year extra. You have to have you have to have money for the 1 year, and then it's 1 year extra.
Okay.
So it's kind of like your analogy, 6 months. Farming, it's really 12 months.
Yeah. Okay. That's awesome.
Yeah. Yeah. Another thing, and this gets a little bit in the weeds, and so I won't say as much about this as I did the last two. Is it's very important that we really make sure that any strategy we have related to mitigating taxes. In the U.S., for example, we have very generous depreciation rules where you can write off a lot of an asset purchase very, very quickly, and that's great. That's fantastic that we have those opportunities. They're not just for farming. There's really good opportunities for all small businesses in the U.S. and other countries. But we need to make sure that anything we do to mitigate taxes is consistent with our strategy, that we're still going down this road of maximizing profit. And so profit and cash flow are the king, not mitigating taxes. And so the classic case here is I buy a tractor, for example, because I want to save some taxes, but I really can't afford that tractor. And so when based on my profitability projections for the next few years, it looks like I'm going to have a difficult time justifying the purchase of that tractor. And so we want to make sure that our tax strategy is in line with our other strategy, business strategy, which is related to profitability.
I love that. So what you're saying is don't make a big decision to avoid taxes that's going to negatively, you always hear people going, I got to pay taxes, so I got to go out and buy this. Wait a minute. Yeah, but that's that short-term hit. How does that affect you down the line, right? Yeah. That's what you're saying?
Yes. And I used to do a lot of work with cow-calf producers in Kansas. I mean, we don't have as much beef in Indiana, so I'm doing less of that. But this also came down to retained ownership. We typically were fall calving herds, and so if you retained ownership, you weren't selling calves in the current year; you were selling them in the upcoming year. That has huge tax consequences, and it's not necessarily that you couldn't work that out. You just need to make your tax strategy consistent with your business strategy. And so, if that's what you're going to do retained ownership. You need to make sure that you understand the tax implications of that.
Okay, excellent.
Another point I want to talk about, I've got a couple points related to risk, and this can get very, very complicated very quickly. And so let's just talk about this in more general terms. And when we make decisions, let's say we want to. I've done some work recently looking at organic crop rotations and seeing how the profitability of organic crop rotations compared to conventional crop rotations. When we're looking at organic crop rotations, we're not only looking at the profit prospects, we also have to think about risk. And what do I mean by risk when I'm talking about the organic crop rotations? Well, number one, it takes 2 to 3 years to transition into the organic crop production. And during that 2 to 3 years, you've got to use all the organic production practices, but you don't get organic prices. It's extremely risky. You essentially have to have working capital to get through those first 2 years before you get the possible higher profits in year 3 or 4 from producing the organic crops. And so kind of something we talk a lot about in finance. You don't necessarily take on this additional risk like this transition to organic unless you're going to be very well compensated for making that transition. And so it's not just, is organic more profitable than conventional? That's not the right question. Is the compensation for organic big enough to offset the fact that I had to go through 2 or 3 years of very low profitability?
You are hitting all my pet peeves on the nose.
Yeah.
I see so many people that hop into, and there's nothing wrong with it. Great idea. They hop into organic production, maybe in beef too. And then you go, wait a minute, is there enough of a demand for your product that warrants how long you have to grow that animal? I'm not an expert at it, but same type of concept of what you were saying, right?
Yeah, and the case I'm dealing with now is organic corn. Traditionally, organic corn has been a very profitable crop. Well, guess what happened? The last few years was quite profitable for organic corn. So what do you think people did when they went into organic production recently? They produced organic corn.
Yeah.
The supply went up, price came down, and so my point is, you can't avoid some of these risks necessarily, but you need to have your eyes wide open and realize that the demand for organic crops in this case is different than the organic for conventional crops. The demand for conventional crops, even though the price sometimes is not very good, is there.
Yes.
It's going to be there. That's a huge industry. Organic, it doesn't take that much of a blip in supply, and the price is going to respond dramatically. It's just extra risk. And so again, the concept is I have to be very well compensated in order to take on this additional risk. When I used to talk to the cow-calf producers in Kansas, I'd say, think long and hard about whether you want to finish your calves. Backgrounding is not so risky. Getting calves up to 750 pounds wasn't quite as risky. But taking those cattle all the way through finishing added tremendous risk. Some years you lost several $100s per head by feeding those cattle out if you didn't have a marketing strategy, and so that's something they had to think about. Does that extra compensation is that worthwhile given the risk that I have to take to retain ownership?
Love it.
And one of the things that was very interesting about a study we did with a student, Ted Schroeder and myself, Kansas State, a famous livestock economist, and myself and a student, we worked on this project looking at retained ownership, and we tried to ask people whether they were risk averse or risk neutral. So how important was risk aversion to you, or how did you really not able to sleep at night and you had a risky situation? Guess what we found? The people that retained ownership through the feedlot the risk wasn't that big a deal to them compared to the people who did not retain ownership. And so this all works out, but it's something to think about when you're making decisions.
You just nail these points.
Yeah.
We did the same thing. We backgrounded some heifers, and that was our introduction to farming. A few things went bad. We bought them high and then sold them low right after BSC. Pasture wasn't great, a whole bunch of stuff. But I said to Anthony, the backgrounding game is not for me. Yeah. And I'm okay with risk, but we went away from that one.
Yeah. Another concept that's related to risk is the way I've stated this is not all risk is created equal. What in the world do I mean by that? What I mean by that is if you're taking on a risky venture like organic, is the organic going to be 10% of your operation and the other 90% is conventional? That's not as risky as going into organic with 100% of my acres. A classic case down here, and I don't know if it is for farmers in Canada, is people are looking at hemp. And I just say, time out, guys. First of all, do we have a market for this? And if we do, how much supply is too much supply? Yeah. And so if you're going to do hemp, do it on a really small portion of your acreage, see if it works. And so that's the whole idea of not all risk is created equal. We can diversify some of the risk away. If that's just a small part of our business, this venture that's risky, it's not quite so risky to try that out. And farmers do this all the time. We do all kinds of field trials down here where they try different fertilizers, different seed. That's what they're doing. They're testing something out. And so do the same with any new venture. You go back to the cattle backgrounding again. Just background a portion of the cattle. See how it works out. You don't have to background every single head on the farm and risk everything. And so taking baby steps with respect to risk is always a good idea.
So what I hear is you don't recommend going all in and betting the farm.
No.
I'll reword that. I don't prefer going all in and betting the farm on an unknown venture.
Yeah. And for me, it's somewhat difficult to teach this sometimes because I always have to remind myself that one of the reasons I'm in academia rather than farming is I'm extremely risk averse.
Okay.
I don't like risk. I'm one of those people that would have trouble sleeping at night if I got into something that was really risky. And so not everybody's built like that. And so it depends a little bit on how people view risk.
But to me, I think there is taking a risk, a calculated risk.
Yes.
And there's being silly, right?
Yes.
There's always a learning curve to everything. And what I found in business, it usually doesn't go according to plan. So why don't we learn on a small scale instead of betting the farm on it? That's kind of my take, what I've learned.
Yeah. And most of the organic producers we're talking about have taken this to heart. I mean, a lot of the people I know that have gotten into the organic production business recently, they start with a very small part of their farm and they see if it works. And I'm talking to the people where it does work because I don't necessarily talk to the people that tried it and it didn't work. And then if it was successful, they build from there. And so that's always a good idea to keep in mind. And one of my former colleagues, which I did a lot of work with, Michael Langemeier, he used to put it this way: if you get into a venture, think about what it costs you to exit. It's the same idea related to risk here, and you don't want to get into something that's risky and very expensive to exit. What I mean by that, you don't want to get into something to such a large extent that you risk losing everything if you have to back out of that. And so this whole idea of starting slow, learning how to do something, and then if it's profitable, expand it.
I love it.
Another thing that's very important, and this is really an easy concept once a person is measuring cash flows, is all decisions are made looking on the margin. And so what I mean by that is if we're getting into any venture, even if we're changing like fertilization strategy for corn, for example, we always ask the question: if I change my fertilizer strategy, i.e., apply more fertilizer of certain types, is that paying for itself? And so we look at the benefits and the costs. And once we have a good handle on our cash, this becomes second nature to do this. And so every decision we make, we say, are the benefits larger than the costs? Particularly making decisions on the margin, like changing fertilizer, changing seeding rate, going from corn to soybeans. All of these decisions, we're asking ourselves, is the benefits bigger than the costs? And so that's also a mistake that some people make, is they don't do that.
Okay. That's a straight
another concept, and this I'm going to use the organic crop rotation on this one again, is what finance individuals or people that teach finance call the time value of money. All that is a fancy way of saying that money received 3 years from now is not worth as money received today because of inflation and interest. Even though the interest is really low, it's not negative in Canada and the U.S. It's low, but it's not negative. And so that apply that concept when you're making decisions, particularly long-term decisions. And so let me talk about the organic crop rotation again. That first 2 years is going to be extremely rough. You're going to have low profits. If you plant like organic alfalfa, that's a pretty profitable crop. Let's say the third year is organic alfalfa. That can be a pretty profitable crop. Just realize that the profits for the organic alfalfa are occurring 3 years out, not today. And so you have to reflect the fact that those organic profits are down the road and not being received today. And so there is some calculations we can make to try to adjust for the fact that the profitability is occurring over time, and it's not just looking at profitability in the current year.
Ooh, I like that one.
Yeah, and so one of the things I encourage people to do is there's a lot of information on the internet related to time value of money, and it's really not that difficult of computations. You're just adjusting future profit estimates for inflation.
I love it.
Also realize it's riskier. It looks like, I'm sitting here today, and let's go back to the organic corn. I want to plant organic corn in year 3 because that's been profitable historically. Those profits in year 3, not only now your projected profit might be pretty good in year 3, it's risky. Much more uncertain with what organic corn is going to bring 3 years out than today.
Yes.
And so that's the idea here is when we're making decisions is just reflect the fact that the cash flows occur over time. They don't all occur in the next year.
Okay, can I kick it beef producer for a second?
Oh yeah, of course.
Anthony and I, we've done this calculation, and let me know if this is what you mean. The example of buying open heifers or bred heifers. Mm-hmm. Open heifers are cheaper. Bred heifers are more expensive, but you're getting a calf quicker. And then you get money back quicker. And it's less risky because, if they're well along the way of being pregnant, chances are that'll stick. You don't know how many ... right?
Yes.
Okay.
That's an excellent example. And you go back to retained ownership again. If you sell your calves in the fall, you've got that money right away. Mm. You're trying to compare that to finishing cattle, maybe selling the cattle in July and August the next year. And so you do your calculations, and we try to measure what the potential profitability is of finishing them out and selling them in July and August. Just remember that's several months down the road. That's really risky, and you're tying up your money. If you typically sold your calves in the fall, you did that because you probably needed cash flow. Mm-hmm. You were paying bills by selling those calves, holding on to those calves. What are you going to do with the fact that your cash flow is so much different? And so it's always important to think about when did the cash flows actually occur, in addition to just looking at an average additional profit.
Well, and me too. And I don't know if there's other producers thinking about this, but even the current COVID environment, the political environment, how up and down we are all the time on the cattle markets, that now plays into our decision making. Okay, well, we know it's this price here. We could hold for 2 months more, hope the price is better. But what's the world going to be in 2 months from now, right?
Yeah.
And it's crazy. Crazy.
Yeah, think about it. It's going to be really difficult. I have another example related to this. It's going to be very difficult for people in the Corn Belt in the U.S. To decide whether to grow relatively more corn or relatively more soybeans in 2021. If you just looked at the prices right now, hands down, soybeans is more profitable.
Okay.
But the soybean prices today are much higher than the projected prices for the fall of 2021, and so that's difficult. Do I think that the prices that are occurring this fall, are they going to have some legs, so the prices are going to be relatively strong going into 2021, or do I think that we're going to grow a lot more soybeans in the U.S. next year, and so the price is going to decline, and so this gets pretty complicated, but the reason I say this is just be aware of this when you're making decisions. This is not an excuse not to budget. In fact, it actually makes it more important to budget, to create a budget, and then what I call sensitivity analysis. That's just a fancy way of saying is do a soybean and corn budget for 2021 with several different corn and soybean prices. How does it, what does it look like? Does it look like I should grow 50-50? Or should I, grow a few more soybeans compared to corn? I mean, use that budget and sensitivity analysis to help you make decisions.
Love it. Love it, love it, love it.
Okay, the final thing I want to talk about here is what the finance literature calls efficient capital markets. They always come up with these nice sounding terms. All they mean by efficient capital market is markets are very quick to make adjustments And it's very, very dangerous. This is particularly important when you're doing marketing plans. It's very, very dangerous to think that you're right and the market is wrong. And so let's go back to that soybean case. Right now, soybean prices in the Corn Belt are close to $10.40 to $10.50 per bushel. You look at projected prices and adjust for basis in the fall of 2021, and they're about $9.50. So much, much lower in the fall of 2021. It's very dangerous to think that, I think that futures market's wrong in fall of 2021. And so I'm going to count on soybeans being 1040. Second guessing the market. Very dangerous, and you can lose a lot of money quickly making decisions like that. And so just realize that if something looks too good to be true, it probably is too good to be true, because markets adjust very rapidly. Probably another example, let's go back to hemp production. Let's say that I don't have any prices for hemp available, but let's say the price looks very attractive, and it looks like it's going to be very profitable. Put some of my acres into hemp production. What would happen if not only you thought that hemp production was going to be important, but all these other people, in your state thought that hemp was going to be important, and the state to the south of us, in Kentucky, in our case, thought hemp was going to be important? How big is that market? Probably not that big. And so always be thinking about those things. You're thinking about those things when you're making decisions.
I love it. I love it. Do you have a spot in your class, Michael? I want to come to
there's
school.
A spot.
You're great.
Yeah, thank you.
Okay, those were the 8 points, right?
Yeah, those were my key points.
Excellent. That is all good stuff. You know what? So often, I can't even go over that, and I won't. That was amazing material right there, but you just hit the nail on the head on a lot of stuff that I hear different advisors and professionals talking about, but it's not often a conversation that we flat out just say, do the numbers. A dream is a dream, right?
Yeah.
A dream is a dream, but unless it can be supported on numbers and we have a backup plan, flipping out of agriculture, one of the things that drives me bananas, and risk is great and dreaming is great. I'm the biggest entrepreneur and risk taker, but the concept of build it and they will come, that's the biggest joke in the world.
Yes.
Nobody knows you popped up your business unless you're on primetime New York Avenue. Yeah. If you're in a little area, you don't build it and it comes. And I mean, coming back to agriculture, there's so many simple and smart, practical things that we could do that you shared that would just save our skins.
Yeah. And entrepreneurs, they're always looking for opportunities to put their money in different ventures and so on. And I'm not discouraging them from necessarily taking a look at that, but just have your eyes wide open when you're doing that. And first of all, don't put all your eggs in one basket. That's something that we've talked about for decades. So start slow, but also make sure you understand what the consequences are if this doesn't work. That's why producing hemp on 10 acres when you have 3,000 acres is not particularly risky. Or doing organic production on 10% of my acres when again I have several hundred or several thousand acres is not that risky. And so and think about what would happen if this went south and I had to pull back from this venture. And so going back to what Michael Bulgi always talked about, how costly is it to exit? And so I don't want to discourage people from looking at opportunities from bringing family members back. Just crunch the numbers and use more than one scenario when you're crunching these numbers. I mean, there's a huge literature on what they call scenario planning, and that's incorporated into business planning, where you look at a kind of a most likely scenario, a best case scenario, and a worst case scenario. Just do yourself a favor and do those three scenarios. Particularly that worst case scenario. what would happen if things don't turn out very good? Like the organic corn. What if organic corn has almost no difference between organic corn and conventional corn? Well, I guarantee you organic corn is a lot more expensive to grow. That would be an absolute disaster. And so just do yourself a favor and just do the homework.
I love it. That is gold. And I guess that's the amazing part with farmers too. The fact that farmers out there in the audience that are watching this, the fact that we get up every day and continue every year after all the uncertainties and the failures, and the fact that we can do that and literally, like you said, okay, soybeans or corn, we don't know what it's going to be. Roll the dice, right? We're the biggest gamblers. The fact that we can do that and continue to farm is amazing. But you're right. On the flip side, that also makes us those same people that want to try new things that might be a little more risky, right? Yeah. Which is what makes us who we are. But me too, I found if I'm not looking at the numbers in my business, I have this term, and Anthony, I feel unsettled. And don't forget, I'm not a numbers girl here. I'm not the accountant. But if I haven't seen my financials for a good month, I start to feel unsettled in life. And I go through the list. Okay, well, what's bothering me? Wait a minute. I haven't looked at my numbers. And I say to Anthony, I said, I'm getting a little wiggy. I call it getting wiggy because I just feel a little weird, a little out of control, a little, and this sounds so dramatic. It's obviously on a lower scale, but it feels like everything's operating with so much uncertainty. And actually FMC, Farm Management Canada up here, they are a nonprofit organization dedicated to helping farmers succeed with business resources. Mm-hmm. I just did an interview with them, and they've actually done 2 studies. And one of the most recent, actually the episode's airing right now, their most recent study was titled Healthy Minds. Let me get that right. Healthy Minds, Healthy Farms. So they do a direct correlation between farmers and their farm business management practices and mental health. And when I was talking to Heather, sitting there going, no doubt, I didn't say it in that episode, but I do get wiggy. I'm unsettled. Yeah. I feel not in control. And, you know, you really aren't that much more in control when you look at them, but you are, you know your numbers and you know where to go from there, right? If you're making decisions blind, oh my gosh. Yeah. Yeah.
Ignorance is not bliss in this particular case. That for sure. Knowing is so much better than not knowing, because you can make adjustments. Yeah. You make adjustments to your business plan, to your operational plan, to try to help prove things. One of the things I also want to say regarded to finance and risk management for that matter, as a farm gets larger and there's several people in the business, make sure that one person is responsible. At least one person's responsible for putting together the financial metrics. Okay. And assign that task to somebody specific. And it's the same idea. If we used to have a lot of crop livestock farms in the Corn Belt in the U.S. We have less, but we still have several of them. It's the same idea that one brother was in charge of the agronomy and the other brother was in charge of the hogs. It's the same idea. Give somebody the responsibility for keeping these metrics up to date. That way, when you come to a family meeting and you talk about buying a combine, or you talk about adding a family member, you talk about buying 160 acres that's real close to us, we have the numbers person there to say, this is where we currently stand, this is what we currently can afford, and so they can make a decision with that information.
Oh, I love it. This is gold. I could talk for hours.
Yeah.
With you.
Fun stuff.
This is awesome, Michael. Thank you. And I might be going online to see if I can find a spot in your class. Well, sneak across the border will be my biggest hurdle.
One of the things that putting together this list, I had this list put together, but not exactly in this format or in this order, is I think I'm going to write this up. And so one of the things I'm going to try to do in the next 2 or 3 months is try to put some flesh behind some of these biggest financial mistakes and put those on our website.
Oh, love it.
Yeah.
Anything that we can take away. And when you do, let us know. And
I will.
I can tweet that out to our audience as a nice way, right?
Yep.
That's fantastic. I want to thank you so much. I could tell you're so passionate about the subject and I love it. To me, I think financial is the game changer behind any business. So thank you so much. You shared so much wisdom there. I don't know if you want to try and top that. I'm sure you could, but do you want to leave our audience with any parting words?
The only thing I want to reiterate a couple of things that I've talked about during our discussion is, one, make sure you measure financial position and performance. Make that a goal. If you're not currently doing that or you're not doing as good as you'd like to, make that a goal for 2020. I'm going to end 2020 by making sure I have really good balance sheets that I can use not only for the lender but also for myself, and I'm going to measure profitability. I haven't done a very good job in the past of doing that, but this is the year that I'm going to measure profitability. And so set that as a goal. The other thing I as a takeaway is, again, for these farms that have several family members or several operators, make sure you have someone that's responsible for financial management, for calculating these financial metrics. It's just so much better to come to these family meetings, for example, and have those numbers. I have that person bring those numbers forth to help the family make a decision. So those are my 2 key points.
Love it. Thank you so much. I just enjoyed that so much. Appreciate your time. And thank you in the audience for joining us. If you love this episode as much as I did, like it, share it, and subscribe to the channel. And I will see you guys on the next episode. And thank you so much, Michael. Take care, everyone.
Yep.
Bye.
Bye.
You've been listening to Impact Farming. For more great episodes and articles designed to help you manage and grow your farming operation, head on over to farmmarketer.com. Don't forget to sign up while you're there. We will see you on the next episode.